the Fed decided this month to hold rates steady with an outlook in 2024 saying that they expect around 3 to possibly 4 cuts coming in 2024. So what does that indicate for equity market as well as the REITs? Well, let's take a look at the historical performance, and what we can see is that REITs historically outperform after the Fed tightening cycle. So if you believe the Fed's tightening cycle is finished, and they are, similar to the articles looking to cut from 2024, well, when we take a look in terms of what happens during the cycle of the tightening, we can see that the public real estate is down, the worst performing, still up at 9.6%, lagging behind the equity market at 9.7%. Now, forward looking to plus 1 quarter, the 2 and 4 quarters ahead, what we can see is that on all 3 occasions, the public real estate sector is outperforming the equity market. And this is one of the reasons in today's episode we are going to be focusing on a company that I have not only been buying, but one that I am also continuing to add to the portfolio, which is VICI Properties. Now, we're going to run through why VICI Properties is one of those REITs that I have been adding. We're also going to take a look and get to the intrinsic value. I'm going to explain what I believe to be the acceptable buy price in today's market given my own investor margin of safety, as well as what I believe other investors may look for when targeting this. And we're going to take a look at their dividend safety. We're going to run through some important financial metrics, taking a look at how strong this company is for the foreseeable future. We'll also take a quick look at an update to the institutions if they've been buying or selling, as well as the sector as a whole, what we can see in terms of trends year to date as well as the last 5 years. And finally, we will touch upon their income statement, their trailing 12 months for 2023, what we expect on both the top line and bottom line, as well as seeing how healthy this company is in terms of their cash versus their total debt. So today's episode, it is focusing on VICI Properties. Now, it is pretty much flat year to date. We do sit in the midpoint of the 52-week range, and it does offer a yield of over 5%, currently sitting at 5.32%. Now, if you've been holding this over the last 5 years, you would be up around 62%. As we can see, it did have a huge drop down to that COVID point to $11 and has picked up subsequently since then. So it is looking in fairly decent shape over the last 5 years, but we do see its all-time high in the summer of around 2022 at around $36. So let's take a look and run through this company. Now, on the top line of REITs, what we typically look for on the revenue, 5 to 10% growth year on year. 900 million reported in 2018, December 22, 2.7 billion. So that is some strong growth over the last 5 years. On a more granular level, we do see it remaining fairly flat from 18 to 19, before picking up quite nicely to 20 to 21 and 2022. On top of that, we see based on the trading 12 months, 3.5 billion estimated for December 23, which shows some strong growth from the previous year. And don't forget to smash that like button and subscribe button if you want to effectively be notified of when these videos are dropping and when we will be releasing the analysis on the latest VICI Properties 2023 annual report. Now, when we take a look at their bottom line net income, what story do we see? Well, 524 million on the bottom line in 2018, 1.1 billion in 2022. So they have effectively doubled their bottom line over the last 5 years, which is positive to see. And when we look on a more granular level, we actually see that they have increased or managed to increase, in fact, their bottom line consistently, with a very strong bottom line looking likely for December 23. So lots to like in terms of their income statement. How does their effective balance sheet stack up? Well, total cash versus total debt, 580 million of cash in 2018, 511 million in their latest report. So they still do hold a fair amount of cash, very slightly lower than what they did 5 years ago. Total debt then, however, what we can see a large increase from around 4 billion to around 17.5 billion, which is fairly typical when we do look at REITs, and we will explain why shortly. And we'll also look at that net debt to EBITDA metric, which shows us the strength of the balance sheet as well as the dividend safety. So in terms of comparing it to others in the REIT industry, we have Iron Mountain Gaming and Leisure Properties, as well as a few well-known others. And we can see year to date, VICI is up around 4%, one of the middle of their peers, and that includes those dividends reinvested. When we take that to the last 5 years, what we see, it is one of the best performing behind IRM, up 147%. So they have had a very strong last 5 years, but as always, past performance isn't an indicator for the future. Now let's take a very quick look at institutional ownership. It does sit around 97%. Around 2 billion of outflows over the last 12 months, and during the same period we see nearly double the inflows. So institutions do like VICI Properties. It is something they have been buying more than selling, and the trend over the last 4 quarters, as we can see, is more buying depicted by the green than selling depicted by the red. So lots to like here, but as always, likewise with institutional ownership, always do your own due diligence. Let's not just go ahead and copy what the institutions do. Now, in terms of their dividend safety, it is sitting at a score of 50. It is borderline safe. Market cap 32 billion. It is a large cap company. Now, in terms of some recessionary metrics, well, this company wasn't formed in 2007, 2009, so we don't have the data. So we can jump straight into the dividend growth. Very nice to see the latest increase above that inflation. I always advocate on the channel to get more than 4%, sitting at 6.4% this year. Remember, you're also getting a fairly nice starting yield of around 5.32%. So when we take a look, for those that are new, it has been paying dividends since inception for the last 4 years. And when we take a look at dividend yield theory, well, we can see you could argue slight undervaluation / reasonable valuation. So dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average, as we can see now. Forward P to FO slightly under than the 5-year average of 14.3 versus 14.8. And when we compare it to the market sector, in fact, at 14.1, it is pretty much near that. Now let's take a look at the payout ratio. And for REITs, as always, we focus on the adjusted funds from operations. Free cash flow payout is more volatile. 75% or lower is what we target for hotel REITs. They have been pretty consistently around that area for the last 5 years. 2023 expected to be around 75% as well. Now, in terms of the adjusted funds from operations, some nice growth over the last 5-6 years. 2023 expected to be more of the same with a growth to 2.12. So it is a fairly nice growing company, and it is positive year on year. Sales growth over the last 3 years, some very, very large increases. Remember, 5 to 10% is the minimum we look for. 2022, 76%. 2023 expected 54%. So this is one of the more fast-growing REITs than those we do typically analyze on the channel. So then total sales, 200 million in 2017, 2.66 billion in 2022, with 3.47 expected in 2023. Now, this is a lot of positive, but there is one thing just to say for REITs in general, they do the opposite of what we like. What we typically like to see in companies is when they do share buybacks, returning excess cash to our pockets. And what we can see here is they do the opposite. They do dilute your position. They issue shares. The reason for this is to fund property acquisitions. And this is because they do retain a little of that internally generated cash flow after paying dividends. But you will notice if you see the reviews on the channel of REITs, some companies do dilute your position at a much quicker rate than others. ROIC, well, 3 to 5% is what we look for REITs. It gives us faith that management are able to effectively allocate their capital. And we can see for the large part it has been about that. 5% in 2022, 8% in 2023. So lots of positives to like. Operating margin as well, very nice, very high, fairly inconsistent, but still even the lowest point is very strong, with 2023 expected 91%, which means in theory the higher the operating margin, the higher that bottom line net income, so we should expect some nice dividend increases in 2024. Now, net debt to EBITDA stands for earnings before interest, tax, depreciation, amortization, shows us two things, the dividend safety as well as the balance sheet strength. So these numbers are essentially the number of years it would take the company to pay off all of their debt, net of cash on hand. Personally, what I like to see is 3.5 or lower for hotel REIT specifically. It is significantly higher in 2022. Now, 2023 it is expected to come down, with 24 even lower, but it is something I would just keep my eye on, as you do not want them to have a very high level of debt in comparison to their cash. So something just to be aware of for VICI Properties. Now, before we jump into the valuation model for VICI Properties, we can take a very quick look at their latest investor presentation and just point out a few things more for those who are new to VICI Properties or for those that want to recap. Now, they are 100% triple net leases, meaning every single one of these companies are responsible for paying for their taxes, the maintenance, the upkeep, which is always positive to see. And what we can see in terms of the number of properties they have 92 properties with 12 tenants. A lot of these are very famous, well known, and some of these on the Las Vegas Strip. We have Caesars, we have MGM Resorts. And when we take a look at this, we can see that they have around 12 tenants and 92 properties with the weighted average lease term 41.5 years, which is very strong, which means they are effectively locked into these contracts for a very, very long time. And if you were looking at the annualized cash rent, the two biggest ones, Caesars and MGM, do make up approximately 75%, so 3/4 of their total revenue. The other thing I did just want to point out, 2020, when we had the recession, when a lot of these casinos were shut down or other tenants had all of their places shut down, we see that their rent collection for VICI Properties was 100%, and the typical for this industry is around 70 to 99% for effectively the triple net leases during COVID. So there are a lot of positives with VICI Properties, as we have mentioned. And in terms of the diversification within their own portfolio, as we mentioned, on the Las Vegas Strip, you also have hotel rooms, you have gaming spaces, meeting and convention spaces, food and beverage outlets, entertainment venues, retail outlets, and also for those that didn't see one of our latest episodes where they did essentially buy a bowling alley venue, that is also something else that they have added to the chink in their armor. So this is a very well company, very well positioned, some very strong financial metrics. And now let's get into the valuation model. And as always, if you enjoy the content, values being provided, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And do click on that pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. First model, well, Graham's valuation, regular viewers know that this isn't applicable for REITs, so we move on to the first one for today's episode, which is the REITs multiple valuation model. We have these companies which we analyse over the last 5 years, their total return, their P to AFFO multiple, the average, and we have that of VICI to give a stock price on this model of $32.69. Now we can take a look at that current price and it shows around 5% upside, so reasonable valuation based off of our first model. But do remember, we don't look at any of these models in isolation and we will draw our conclusions towards the end. So the average growth rate for the DDM model, which is the second model here with the yearly dividends, it comes to around 9%. Very, very strong, very nice dividend increases year on year. Forward looking, I have gone a lot more conservative at 4%. As always, if you do grab a copy of the model below, you can play around with all of these numbers. This gives a DDM price of $44, which I would say is on the more conservative side. Some strong upside to that current value, as we see here, and above that 52-week high, showing signs of undervaluation. We then move on to the DCF model with our free cash flows year on year. Average growth rate, very high. Slightly more conservative target than analyst estimates. We get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, to get a DCF price of $38, again above the current trading price, around 20% upside, and above that 52-week high that we've seen not too long ago. So the intrinsic value here is just the average of those three models for today's episode of VICI Properties, and this comes to around $38. Now the current price sits around $31.72, and what we start off with is usually 10% margin of safety if we believe it has a wide moat, strong financial metrics and good forward-looking data, and we can see it would be an acceptable buy up to $34. At a 15% margin of safety, it would be a buy up to $32, and a 20% margin of safety, it would be a buy at around $30.46, around $1 shy of the current trading price. Now, as I mentioned, this is one that I have been buying a lot over the last few months. It is one that I've regularly, in fact, reviewed on the channel at points when I have been buying, or targets that I have been looking at. And if we go back, I have been buying it all the way down to its 52-week low. And we can see here at the 20% margin of safety, which is what I would personally use as an absolute minimum, I have been buying up to around $30 and will continue to do so over the next few weeks and months if we do see it dip below that. In terms of Wall Street, well, they do believe there to be some nice upside to the current trading price at around 15%. So right now, what we are saying for VICI Properties in conclusion is that you are looking for around a 15% margin of safety currently based on our estimates and judgments, with Wall Street saying around 15% upside over the next 12 months. As always, let me know your thoughts and comments below. Is this one you are looking to add? Maybe one that you have been adding already, or something you are looking to add in the foreseeable future. As always, smash that like button if you've enjoyed the content, hit that subscribe and bell button if you are wanting to be continually notified of these videos as they drop. And finally, do click on that pinned comment below where you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio or on your watch list. Have a great day and catch you on the next episode. Take care.